Welcome to ICC Lab. I'm Taylor, and here we don't predict gold. We wait for the market to prove itself through indication, correction, and continuation. We call it ICC. Today, I want to break down 3 mistakes I see beginner traders make every single day, and more importantly, what you can start doing differently before your next trade. So let's get into it. The first mistake is entering a trade without knowing what the trade is actually supposed to do. Basically, you're trading without a plan. So, would you start driving across country without knowing where you're going, without knowing where you're headed, without knowing how you're going to get there? Hell no, of course you wouldn't. But traders do the equivalent of this every day. They click buy because the candle looks strong. They click sell because price feels too high. Then once they're in the trade, they start inventing the plan. That's ass backwards. Now they find themselves asking, where should I place my stop? Where should I take profit? Do I hold? Do I add another position? If you find yourself asking those questions after you enter, you didn't enter with a plan. You entered with hope. And hope gets very expensive very quickly when you're trading gold. So before you enter any trade, you should be able to answer a few basic questions. One of the first questions is, why am I entering? What justification do I have for entering this trade? Or basically, has the market confessed yet? The next question is, where's my entry? Where's my failure level? And where will I take profit if the market proves me right? All these are very important and relevant questions. For an ICC trader, that means you should be able to identify the indication, explain what structure it damaged, and show the correction preserved the claim, and define what continuation would confirm. If you can't explain your reason for entering in one clear sentence, you don't have no business entering that trade. It's really just that simple. So let me give you an example. I am considering a long because price damaged a meaningful high, corrected without invalidating the bullish claim, and is now showing continuation above the damaged structure. That, my friend, is a thesis. I'm buying because it looks bullish. That ain't no thesis. Excuse me. That's an opinion wearing trading vocabulary. Now, there's a simple fix for this. Before each and every trade, write down one sentence explaining why the trade exists. Then identify your entry, your failure level, your target, and the evidence that must remain valid. Excuse me. If you cannot do that before clicking buy or sell, don't enter that trade. It's not a trade. It's not a trade. No explanation, no execution. The second mistake is risking so much money, damn, that one bad decision can severely damage your account. Risking too much on a single trade. A lot of new traders are trying to turn a small account into a fortune as quickly as possible. They've watched traders like Psy, but they don't take into account that, excuse me, Psy's been trading for 3 or 4 years, religiously. 3 or 4 years. So instead of thinking about survival, these traders that are trying to hit what I call a lick, a major lick, they're thinking about multiplication. I said that crazy, multiplication. They put 20, 30, sometimes 50% of their account behind one trade. My God, excuse me. And when the trade works, they feel like a genius. But when it fails, they lose several weeks or maybe even several months of progress in a few clicks, a few minutes. It ain't worth it. That ain't aggressive trading. That's poor risk control. So no matter how attractive the setup looks, you do not know what the next trade will do. You can't predict that. No one can. You can have a strong thesis. You can have a clean structure. You can have the indication, the correction, and the continuation, but you cannot control the outcome of an individual trade. Your job is not to make one trade save you. Your job is to prevent one trade from destroying you. Many traders use a risk guideline of around 1% or less per trade, while some allow 2% depending on their system, their experience, account rules, and tolerance for drawdowns. The exact percentage matters less than this principle. You must risk small enough that a normal losing streak does not remove you from the game. If you have a $10,000 account and risk 1%, excuse me, bear with me, your maximum planned loss is $100. If the trade fails, you still have the financial and emotional stability to evaluate the decision and take the next qualified setup. But if you risk $3,000, $3,000 on that same trade, the loss doesn't just damage your account, it changes your psychology. You begin forcing trades, you increase your size, you abandon your standards, and one oversized loss becomes the beginning of an emotional collapse. What do? Choose a consistent maximum risk before the trading session begins. Calculate position based on the distance between your entry and your structural failure level. Never move the failure level simply because you want to trade a larger position. And don't ever increase your risk because you feel certain. Trust me, you don't know shit. Confidence does not reduce market uncertainty. Proper risk management keeps a losing trade small enough to remain information, not devastation. The third mistake is chasing price after everybody can already see the move. I call it chasing those big green candles. We've all done it. A huge green candle appears. Social media starts talking about it. The chat rooms light up about it. They get excited. They talking crazy. Everybody is posting screenshots. And suddenly you feel like you're missing an opportunity of a lifetime. You're about to be tricked. So you buy. Click. Not because your setup appeared. Not because the market completed your process. You buy because price is moving without you. That is fear of missing out, FOMO. And FOMO creates terrible things. By the time a move looks obvious, the traders who entered earlier may already be taking profits. So you're not necessarily buying the beginning of a move. You may be providing liquidity near the end of it. This is why one aggressive candle cannot automatically become your signal. Movement is not evidence. A strong candle can be an indication, but it still needs to do meaningful structural damage. Then you need to see how price corrects. Does the correction preserve the claim? Does the price accept the damaged level? Does continuation confirm that buyers are still willing to operate at the new prices? Or did you simply watch a temporary burst of momentum and assume it will continue forever? The market does not owe you an entry simply because it moved. And missing a move is not the same thing as losing money. Sometimes the best decision you can make is allowing price to leave without you. Do nothing. Stop reacting to candles after they expand. Mark your meaningful levels before the move happens. Set alerts around those areas. Then wait for price to reach your location and present the evidence your system requires. Let the chart come to you. If the market moves without giving you a qualified entry, let it go. Don't chase. You'll lose. There will be another session. There will be another opportunity. Your job is not to catch every movement. Your job is to participate only when the evidence justifies your risk. In other words, only after what? Only after the market has confessed. So let's bring everything together. It's a brief recap. Beginner mistake number 1, trading without a plan. Don't do it. If you cannot explain the trade before entering, you don't got no business managing it after entering. You can't do that. It's a losing proposition. Mistake number 2, risking too much. One trade should never have enough power to financially or emotionally destroy your account. And last but not least, chasing those big green candles. A market moving without you is not an emergency. I'm going to say that again. A market moving without your ass is not an emergency. Wait for your location. Wait for your structure. Wait for your evidence. Trading becomes much simpler when you stop treating every movement like an opportunity. You do not need more trades. We've established that in several other videos. You need better standards. We have those with ICC. You need a defined plan. Again, ICC. You need controlled risk. And you need enough discipline to let unproven trades pass without you. Because the goal is not to enter first. The goal is to enter when the market has earned your participation. When the market has what? Confessed. If you're ready to stop guessing and start learning how to trade gold with proof, join us in my school's ICC lab. And before you leave, comment below, which one of these 3 mistakes has cost you the most money? Trading without a plan, risking too much, or chasing price? Be honest, because identifying the mistake is the first step toward correcting it. And remember, no proof, no trade. Thank you for hanging out. And if it ain't ICC, it's not a trade. Peace.